Welcome back to the channel. Today we're diving into one of the most misunderstood areas of the US stock market, stocks trading under $5, commonly called penny stocks. Are they an opportunity? Are they a risk? Or can they actually help small investors grow faster? In the next 15 minutes, we'll break down everything you need to know, clearly, simply, and realistically. Let's get started. In the United States, any stock priced at $5 or below is generally considered a penny stock. These companies are usually small, new, underdeveloped, financially unstable, and they often have high volatility, low liquidity, limited financial information, rapid price swings. Some penny stocks are listed on NASDAQ or NYSE, but many trade OTC, where regulation is weaker. Even with the risks, penny stocks attract millions of US investors. Why? Heavy checkmark 1. Low capital needed. You can enter the market with $50 or $100 and still buy a decent number of shares. Heavy checkmark 2. High reward potential. A small company can surge after a new product, a major partnership, FDA or government approval, positive earnings. A $2 stock can jump to $4, $8, or even $15. Heavy checkmark 3. Early stage opportunities. You're essentially investing at the ground floor. If the company grows later, the return can be massive. Now let's talk about the part most people ignore. Crossmark 1. Extreme volatility. These stocks can move up or down 50% in a single day. Crossmark 2. Low liquidity. You might want to sell, but there may be no buyers at your price. Crossmark 3. Weak financial reporting. Many penny stock companies provide very limited financial details. It becomes hard to evaluate revenue, profit, debt, cash flow, business model. Crossmark 4. Pump and dump manipulation. These stocks are common targets for artificial hype. Promoters pump the stock, the price spikes, they dump shares, normal investors lose. Crossmark 5. High failure rate. Many companies under $5 never grow, never scale, and eventually disappear from the market. If you decide to invest, here's how smart US investors protect themselves. Heavy checkmark rule 1, prefer NASDAQ/NYSE penny stocks. They're generally safer than OTC markets. Heavy checkmark rule 2, study the numbers. Review quarterly reports, revenue growth, cash reserves, debt ratios, insider buying/selling. Heavy checkmark rule 3, limit your exposure. Keep penny stocks at 5 to 10% of your total portfolio. Heavy checkmark rule 4, always use a stop loss. Set a 15 to 20% stop loss to protect yourself from massive drops. Heavy checkmark rule 5, ignore hype. If something sounds too good to be true, it is. Heavy checkmark rule 6, diversify properly. Blend speculative picks with stronger long-term investments or ETFs. Here's the reality for US investors. Penny stocks can deliver huge returns, but only if you understand the risks. They should not be the foundation of your investment strategy. They're best for high-risk investors, short-term traders, people building small accounts who understand volatility. If your goal is long-term wealth, blue-chip stocks and diversified funds are more reliable. Use penny stocks only as a speculative side segment, not a main plan. So, are under $5 stocks worth it? Yes, for the right investor, in small amounts, and with the right strategy. No, if you expect guaranteed results or don't understand risk. Always approach penny stocks with patience, realistic expectations, a clear exit plan, proper research. If you'd like a follow-up video breaking down real examples of under-$5 stocks and how to analyze them step by step, let me know in the comments. This content is for educational and informational purposes only. It does not constitute financial advice, investment advice, or a recommendation to buy or sell any security. Always conduct your own research or consult with a licensed financial advisor before making investment decisions. Investing involves risk, including the potential loss of capital.